If you're getting a mortgage right now or renewing your mortgages soon, there's one question that can save you or cost you tens of thousands of dollars in the next 5 years. Do you go fixed or do you go variable for 2026? Because here's the weird part. The loudest opinions online are usually the least useful. So today I'm doing this the way that I do it with my clients sitting across the table from me. We are going to use real recent numbers and we are going to connect them to what actually matters in 2026. So now I'm going to break it down for you. First, let's look at what is variable versus what is fixed and what does that really mean. Let's make this simple. Variable rate mortgages usually move with the lender's prime rate and the prime moves with the Bank of Canada's policy rate or overnight lending rate. Fixed rate mortgages that are more connected to the long-term bond yields or 3-year bond yields or 10-year or 5-year bond yields. So the lenders add their margin onto those yields and then calculate the 5-year or 3 years fixed mortgages. So the decision is basically this. Variable means that I believe rates will fall enough and fast enough to make this worthwhile, and the fixed rates meaning that I value stability and I think the room for the rates to fall further is limited. Now here's the key. This isn't about being right. It's about choosing the risk you can live with and how comfortable are you with taking that kind of risk. So where are we right now? Let's anchor to the most recent official information. As of December 10th, 2025, the Bank of Canada held its policy rate at 2.25%. This is important because it suggests that we are in a pause phase, not an aggressive cutting phase. So now let's talk about inflation. Statistics Canada's latest release shows that CPI was 2.2% year over year in November 2025 and same as October. So in October it was also 2.2% year over year. So we are not in an inflation emergency, but we are also not in a world where the bank needs to slash rates aggressively. And when Bank of Canada is holding steady, that matters a lot more to the people who are having variable mortgages. It doesn't make that much difference to those who have fixed mortgages. So here's this argument about how stable 2026 would be. So here's the core of the case for stability. There are very little chances of Bank of Canada rising interest rates, and also markets and economists were pricing in no more moves for 2026. There might be one more cut, but that's about it. That's what we heard. And that no move in 2026 idea basically also shows up in recent bank commentary. RBC's economist also has stated that they expect the Bank of Canada to hold rates at 2.25% throughout 2026. This is basically their base case, with hikes more likely later on. So Scotiabank also frames the overnight rate as likely in a prolonged pause unless conditions change materially. Now, does that guarantee stability? No, but it supports the idea that we are not staring at massive rate cuts coming fast. And if rates are broadly stable, then you're not being paid much to take variable risk. That's the heart of it. So what are the banks are actually offering right now? Now let's get practical. What are the rate level consumers actually see online? For example, the RBC posted a special rate. Right now is about 5-year fixed around 4.5% and 5-year variable at prime minus 0.5%, which is about 3.95. That's what RBC or Royal Bank is offering right now. So yes, variable can still look cheaper today, but here's the problem. If your life can't handle payment volatility, or if you're already tight on affordability, then cheaper today may not be worth risking tomorrow. And in real life, most people don't lose sleep over paying 0.something%. They lose sleep when the payments jump unexpectedly. So the big question is, how much downside is left? Here's the line that matters in my opinion. If the Bank of Canada is at 2.25% and inflation is at 2.2%, in my opinion, you're not in the same environment as 2020 to 2021, where cuts could be huge. Could rates go lower? Of course, yeah, it may go lower, but the burden of proof is that how much lower, how fast, and how far it's gonna go lower. Because variable only really wins when first rates fall meaningfully and then they fall early enough that savings accumulate, and then you can survive the risk if that doesn't happen. My approach here is being data dependent, and I think that the Bank of Canada has cut enough for now. So in my opinion, and this is is the part that will annoy the internet. Fixed mortgages right now looks more attractive because of the stability that might be the main story of 2026. Not because you are timing the bottom, but because you're buying certainty. So how would I explain it to a client of mine? If you're a first-time homebuyer, or if you're stretching to qualify, or if you're carrying other debt, I would frame it like this. Variable is the confidence trade. When you're saying, I believe rates will fall enough to reward me. And the fix is basically the sleep at night trade. You're saying, I want a predictable payment in a world where surprises still may happen. And given the data, Bank of Canada holding rates and inflation near the target, big banks leaning toward the pause, I think fixed is underappreciated going into the 2026. So if you ask me today, fixed or variable for 2026, my answer is if you value stability and you don't want to gamble on big rate drops, fixed is very compelling right now. If you have high risk tolerance, cash buffer, and you're comfortable riding uncertainty, variable can work for you. But understand what you're betting on. Let me know in the comments down below, what do you think is the better choice right now? If you want to get connected with a mortgage broker from my team, you can use the link down below. And remember, these are my personal opinions, not financial advice and not a prediction.